Hey, in this video, I'm going to show you how to calculate cash-on-cash returns for an investment in a real estate property. So I have a blog post pulled up here that we wrote, and it's going to do a deep dive into what cash-on-cash returns is, how it's calculated. At a high level, what I'm hoping to accomplish here is just give you a quick overview of the topic, and then dive into one of our real estate financial models as an example and be able to show you how, in reality, this is actually calculated in a financial model. Just to get us level set on the same page here, a cash-on-cash return is a rate of return that's used in real estate that calculates the cash income earned on the cash invested in a property. The way that we would calculate this, we'd look at the annual pre-tax cash flow and then the total amount of cash invested. And so the formula here would be the annual pre-tax cash flow divided by the total cash invested times 100% would give you the cash-on-cash return illustrated as a percentage. And so that would be for the entire project. But the reality is that a lot of times real estate developers or real estate investors might have multiple different investors, and you might want to model or understand what's the cash on cash return for a specific investor in a property. And we've got a set of real estate financial model templates for kind of all sorts of different real estate types of businesses, so from multifamily apartment to commercial real estate to industrial, self-storage, strip mall business models. But I'm going to show you our multifamily apartment complex model here and just show you how cash on cash return can be calculated in this. So once you have done all the work to create a set of projections using the model, you can come to this input distributions tab. And I'll put a link in the description of the video below to this template, so you can go grab this template if you're interested, or take a look at our other real estate related templates that would have this similar or same tab in their spreadsheet as well. But what we can see is we've got a set of cash flow assumptions, and we can set an assumption here about what percentage of the cash we want the business to hold as a cash reserve. And so we can see that here we're gonna hold 100% in the first couple of years, then we're gonna hold 60% as a cash reserve within the business, which means that 40% is available for distributions to investors. So that helps us estimate our distributions for the investors. And then we need a sale assumption. So we're assuming that we're gonna sell this property in year 10 with a certain operating income in the sale year. A 7% cap rate is what we're assuming here as our exit cap rate. And so we're going to get 21 million in gross sale proceeds. We're going to pay off our 11 million in debt. We're going to end up with net sale proceeds of 10.3 million. Now the total equity invested initially was 4.5 million. And we can see the estimated investor share of distribution. So where is this coming from? This is based on how much is being distributed based on these assumptions up here and the cash reserve that's going to be withheld. And so based on those assumptions, we can see, okay, this is how much cash investors are going to be able to distribute. And ultimately that big lump sum here of the 11.6 million at the sale. And ultimately that allows us to say, okay, for this particular investor that we're modeling here, their investor average annual return, cash on cash, you can see the annual return and then the cumulative returns here. So we'll get to see that cash on cash rate of return. We'll also get to see an IRR payback. So you can see the differences between a cash on cash return versus an internal rate of return, which is slightly different calculation here. This is really helpful. Just this calculator, I think, can be really helpful in trying to model different scenarios for your cash on cash return assumptions as you're looking to present to potential investors and look at different scenarios. Now, just as a note here, if you change this cap rate, so if the cap rate goes down, that means your net sale proceeds are going to go up and your returns will go up. So if we just change this cap rate to a 6%, we can see what happens here. So that average annual cash on cash return ended up at 43% versus in the 30 percentile range. And you can also see the IR jumped up to almost 22% as well when you change that cap rate. Just an example of how these assumptions can make a big difference. And you can use this to play around with different scenarios as you're trying to estimate potential returns for you and your investors. I hope this has been helpful. Again, you can go grab these templates in the description of the video below and play around with them. If you have any questions, leave a comment in the comment section or reach out to us at support@projectionhub.com. Thanks.